Again.
And you're going again. This time it's going to be vacation, right?
That's right.
You got some vacation,
That's
well-earned
That's
time
right.
off.
That's right. I'm going to go and try to contribute to the travel economy a little bit and see what I can do.
Well, hospitality and leisure needs it.
I'm sure they do.
Yes.
They've been struggling of late, and so we're going to try to support them all we can.
Yes. Well, Janet's been here for the last couple of weeks. No vacation time for you in the last couple of weeks.
No, but I will be out next week. So it's
rotating
summertime.
time.
People got I'm here, I'm not, I'm here, I'm not, kind of part of it.
Well, I hope everybody had a great 4th of July weekend and getting back into the swing of things, or maybe you're on vacation listening on podcasts. We don't know where you are today, but we hope you've got a question. We've got the opportunity for you to chime in and ask us anything about retirement, about money in general, about investing. We've got a few questions that we've received since we've been asking for those over the last couple of weeks, and we're going to take that on. But if there's anything you want to know and you're watching on our live stream today on Facebook or on YouTube, you can just send that into the comments section and we can address it. And then we're going to ask a few questions a little bit later on in the next segment of Ryan Detrick from LPL Research, the Chief Market Strategist, who is always gracious enough to join us about once a month, and we'll talk markets with him in a little bit. We ready to dive in?
Sure, let's go.
Absolutely.
Well, we're going to start with something real easy.
Yes.
Cryptocurrency.
Yes.
Bum, bum, bum. Yeah, we get a lot of questions, I would say, from clients. I would say in meeting rooms of people who are prospective clients, and we were getting questions on that on today's show. So what is it? What is cryptocurrency, and should I be investing in it? That's our question. So let's talk a little bit about what it is and what it isn't. And I'm going to hand off to you on the expertise on this, because I know that you probably know a little bit more than me about this.
Well, we've dug into it, and clearly it's been a thing for a while, and it's not been something that the investment community has really stepped into in a big way, because it has not been a security. It is still not a security. Cryptocurrency is actually property. It is essentially what it is it is digital money. It's basically virtual currency. So it's a little hard for us old timers to get our heads around this. We're still trying to be sure that we've got some cash in our pocket as opposed to swiping the debit card all the time. And so this is just the next phase of this. But it is a fad. It is and I say a fad, it's probably, without a doubt, I'm sure it's probably here to stay.
Right.
But it is clearly something that is a wild, wild west world. And it's something that we have begun to very, very slightly tiptoe into almost by force, because there's so much hype around it and there's so much talk around it, because Bitcoin has been this incredible juggernaut in terms of return. But there's a lot of questions around the whole viability of any digital currency.
So let's talk about digital currency as compared to what we would just call traditional currency. If you've got a George Washington in your wallet, traditional currency, or even your debit card, frankly, because it is representative of traditional currency. So when you think about this, the difference here is that your cryptocurrency is not backed by any government. So it's a peer-to-peer type of deal that you've got going on without any central authority from banks, government, etc. So it's just not as well defined, really, to use that very broadly to talk about it.
And I think it's really interesting, Scott. People, and this happens with gold too. So let me
very similar in a lot of ways.
Let me develop this a little bit. Some of the most conservative people that I know come in going, "Hey, do I need to invest in gold? Do I need to invest in cryptocurrency?" And I'm like, okay, what happened to you?
Yeah, right.
Because those are volatile assets. Gold is
but it's a curiosity thing.
It is a curiosity thing, and I think that's where the heart of their question comes from, is from a point of curiosity. They hear about it. They hear about these big returns that people are getting, and somebody, mined some Bitcoin the other day, and then, 6 months later, they're a quintuple millionaire or whatever.
Not
that
a true
day.
story.
That day. Yes, right?
Yes.
Tomorrow they may not be.
That's right.
Yes.
And that's how volatile this is.
Right.
And so, yes, there are a lot of stories out there about people actually making a good bit of money in this, but you have to understand that there is that part of it, and then there's kind of the dark side of it as well, because it's basically an unregulated currency, and there's a lot of theft and crime and what have you that is linked to the use of cryptocurrency. And so it has been a very sticky situation for folks in the investment community to get involved in, because frankly, we have a fiduciary responsibility, and cryptocurrency is something that I don't know that you can get your arms around, whether it's in the client's best interest.
Right, and I would challenge you, if you're going, hey, is this my thing? Do I need to do this or not? I would challenge you to ask yourself the question, to what end? Like, what's my end game with this? Because I'll give you an example. We know somebody who actually was involved in mining cryptocurrency early on, before really probably anybody in this room knew what it was, frankly, and did well because of how long they've been in it. But early on, purchased an electronics item with some of that cryptocurrency, and at the time it made sense. I mean, why would I use my money when I could use this? Okay, fine. But in hindsight, when you look back, that was a six-figure purchase that could have been, way cheaper when you measure it in our regular currency. So what are you going to do with it? And at what point, if it's, okay, all right, it's going to fund my retirement, I'm going to get rich quick through this, well, at what point do you get out? Because, guys, if you look at the volatility on this just this year, it's been off the charts. And so, think about what type of an investor are you?
Right.
And when it's up real high, do you go, oh, it's going to keep going up, so I'm going to stay in? Or do you go, let me cash in and I'm going to walk away and not worry about what it does?
I think that highlights the key difference here. Are you going to invest in it as a means of currency, or are you going to invest in it as taking a gain from it and going back to the U.S. dollar at some point, right? Because currency at its most base form is, what is someone willing to accept, right?
Yes.
In exchange for something else. And it's beginning to get more widely accepted, but not to the extent of the U.S. dollar. So to your point, when you're going to use Bitcoin to buy a laptop, the value of that laptop is going to be all over the place if you try to resell it. I think another point of clarity too is that Bitcoin is a type of cryptocurrency. Bitcoin's kind of like Kleenex, right? There's tissues, but but everybody calls it Kleenex. I think Bitcoin can be accused of being everything, and there's tons of them out there, and some could be better than others for quite certain.
Yeah, there's a lot of, as I said at the outset of the show, it's a wild, wild west kind of thing. But, people are creating cryptocurrencies. There was one that was totally fake. It had absolutely no substance in reality, but it had a price on it. The price was going up, and people were buying it, and it was like, okay, but when the merry-go-round stops on that deal, it's the folks that are left holding the bag that really have a problem.
But so let's talk about fraud. What do you do in these circumstances? And really, you're just, like you said, John, you're kind of left just holding the bag, because if there is fraud with regard to actual physical cash, there are avenues that you can pursue to maybe get that recovered. If there is fraud with regard to your bank card, your credit card, there are avenues that you can pursue. With this, you're really pretty limited in the event of fraud or theft. Guys, let's talk about this deal in Japan. So there was a Bitcoin exchange that went down in Japan, and it's called Mt. Gox. And it failed after hackers apparently stole Bitcoins worth, get this, hundreds of millions of dollars from the exchange. So Mt. Gox subsequently filed for bankruptcy, and a lot of these Bitcoin users participating in the exchange are just left, like we said earlier, with very little recourse.
I think the important thing for our listeners and viewers today is that you have to make an evaluation of any security or any investment. Is what role is this going to play in my overall financial plan? Yeah. You know us at Gen Wealth, we're always going to come back to what's the plan. And there is really no definitive role that this can play at this particular point in time, because it's not very well defined what the value of any of the cryptocurrencies are. Now, I want to make a real interesting distinction here. There is Bitcoin and cryptocurrencies and what have you, and then there is this concept of blockchain, and that is an actual technology that is something that you can invest in companies that use blockchain technology. And blockchain is what cryptocurrency actually runs on. Think about the cryptocurrency being the vehicle and blockchain being the road.
Right.
And so the blockchain technology is something that you definitely can invest in. And obviously Bitcoin is something that you can invest in. But blockchain is way more defined and very tangible, where Bitcoin is very speculative. And we have yet to find the ground in which we could go in and recommend a purchase of Bitcoin under any circumstances in someone's financial plan.
Yeah, and then there's the other concept of this too. If you want to tiptoe into these waters, you could actually consider the equity of the companies who are trading the Bitcoin, right, or creating the Bitcoin, because there is the equity side of that as well. Still very volatile,
yes,
but maybe not quite as volatile as the currency itself. But I think to your point, to answer the question that we started with from the viewer is, should I be investing in it? Well, maybe, but not with your retirement money, and that's the key point here. Is if you like to go to Vegas, I would treat this as going to Vegas, rolling the dice, so to speak.
Yeah.
So let's clarify what we mean by Vegas money. We want to be sure that you separate, as Scott's indicating here, that you separate the money that you're going to need for retirement from. I kind of like to dabble in this a little bit. This is what that is. This is your Vegas money. You don't go to Vegas with your 401k. You go to Vegas with, if we don't come home with this, it's okay.
Yeah.
That's what this is.
I think that's the jumping off point, Janet, is if you can invest money and if you lost it all, not saying that you would, but if you lost it all, you could walk away from it and go, okay, I lost it all.
Right.
And if you're okay with that, then okay, maybe an investment into cryptocurrency might be the right thing for you. But we're not going to make that recommendation to you as part of your financial plan, because we've yet to really settle on what this looks like. I think everybody is of the mind that, okay, this is kind of the going thing, and it's going to become something at some particular point in time. But right now, I think what it is speculation.
We've got just a couple of minutes left in this segment, but I do want to kind of touch base on the idea of going it alone in any of these types of investment endeavors, so to speak, because we're going to bring up Robinhood on this, right? Because when you think about tiptoeing into anything speculative, or really the investment world in general, by yourself, what are you getting into? And John, we remember the GameStop blow up and everybody using Robinhood, and we had young people trading and making a lot of money and losing a lot of money, and then we come to find out FINRA gets wind of what Robinhood's doing, and there's a big fine that just got levied on Robinhood.
Yeah, it just happened last week, as a matter of fact. Robinhood was fined $57 million in order to pay about $12.6 million in restitution to clients.
Yeah.
The regulator, FINRA, cited a litany of offenses, including communicating false and misleading information to customers and major trading platform outages. The sanctions represent the largest financial penalty ever ordered by FINRA and reflect the scope and seriousness of the violations. By the way, FINRA is the Financial Industry Regulatory Authority that basically Gen Wealth operates under, LPL Financial operates under, and all of the broker-dealers in this country operate under those regulations. And Robinhood got nailed big time because of some of the irregularities that were connected with that big run-up of those stocks.
And back to your point of the wild, wild west, when you're going it alone, there is this element of the wild, wild west that you're getting into if you don't have a coach to walk you along. Bottom line here is, if you're constantly chasing trends, you're not constantly chasing financial independence. We're going to take a break and be joined after the break by LPL Chief Market Strategist Ryan Detrick as we continue with the Get Ready for the Future show. Ask Us Anything. Back in a moment.
A game warden noticed how a particular fellow named Sam consistently caught more fish than anyone else. The successful fisherman invited the game warden to come along with him and observe. So the next morning, the two fellows met at the dock and took off in Sam's boat. When they got to the middle of the lake, Sam stopped the boat and the warden sat back to see how it was done. Sam's approach was really simple. He took out a stick of dynamite, lit it, and threw it in the air. The explosion rocked the lake with such a force that dead fish immediately began to surface. Sam took out a net and started scooping them up. Well, you can imagine the reaction of the game warden. When he recovered from the shock of it all, he began yelling at Sam. He said, "Hey, buddy, you can't do this. I'll put you in jail. You'll be paying every fine there is in the book." The game warden was just incredulous. Sam, meantime, just simply set down his net, took out another stick of dynamite. He lit it, tossed it, this time in the lap of the game warden, with these words: "Are you going to sit there all day complaining, or are you going to fish?" For some of us, the same question could be asked about our retirement. This is John Shrewsbury with Gen Wealth Financial Advisors. Whether it's trying to find the best investment or just worrying about the stock market, a lot of folks seem frozen with retirement indecision, and that very well could lead to an explosion of your own, an explosion of your dreams for a comfortable future. Plan now for your time on the lake or wherever your dreams take you.
Question? Email info@getreadyforthefuture.com with your name, location, and question to get a response on the air from the Gen Wealth team. Now, back to the Get Ready for the Future show.
Inviting you today on the Get Ready for the Future show to ask us anything. Send in the comment section if you're watching on our live stream today, anything about money, retirement, investing. But for this segment, we're going to be doing the question asking as we are joined, as we are at least once a month, by LPL Chief Market Strategist Ryan Detrick. And we always say we are glad that he's so gracious to join us. Well, gracious takes on a new meaning today because Ryan is actually on vacation and joining us from his car on the phone. So we really appreciate you taking the time, more so than usual, Ryan, today.
Well, Scott, I appreciate it. I mean, honestly, I just ate some lunch. I'm nice and happy. Let's talk some markets. I'm glad I worked out this month of the day.
That's awesome. And of course, you're never really truly on vacation if you're watching the markets, and we know you are. So let's start with the equity market. The markets have definitely still been going strong. Just read on the LPL Research blog yesterday before it ended down yesterday. We were on quite a run, 7 straight days, I think. We were up and we were on a tear, and your team has firmly been behind investing in equities for the first half of the year. That's paid off with big returns in the market. Let's talk about where we go from here. How are you feeling as we move into the second half of 2021?
Yeah, Scott, I mean, clearly this year with the S&P up ballpark 15%, your average bond is about flat, maybe down. It's been a really good year, obviously, for stocks over bonds. And as we head into the second half of this year, we don't anticipate another 15% out of stocks, but we really do think stocks probably will continue to outperform bonds the second half of this year. We get into all the stuff that's happening, right? The reopening, amazing earnings growth. I know some of the recent economic data has been a little bit on the weak side, but the truth is we're probably going to have the best year of economic growth in our country since 1984, and there's a chance if we get a little bit better, it'll be the best since the early 50s. So there's a lot of things out there, and I know we're going to talk about some worries here in a minute, because believe me, there are some worries. But just big picture, one more thing, and then we can go on. It's a good start to the year. I just said that, right? So we took a look last week at what happens when the S&P is up at least 12.5% at the midway point of the year, which is obviously a really, really good start to the year. Last 6 times that happened, the rest of the year was higher. You go back like 87. That's a scary year to hear, but 87 was the last time we had a year start off really strongly, and the second half of the year was actually down. Now, here's the other kicker. The median return the rest of the year, when you're already up at least 12.5%, is like 10% median return. The average year is up like 5%. So what I'm getting at, a good start to a year historically says, listen, there's probably continued gains the second half of this year, and that's the camp that we are in and remain in.
So, Ryan, let's go with the things that you're worried about for just a couple of minutes. First, you say that year 2 of a bull market tends to be choppy. Why is that a concern?
Yeah, John, I mean, I think, the key thing there is maybe it's not a huge concern because you think about it, up at 90% off those lows of March 23rd, 2020, maybe we're due for a break. But I think the key thing is a lot of people have been spoiled. I mean, we've been spoiled, John. We've had a 5% correction on the S&P since October, all right? I mean, it's just been almost 45 degrees straight up. So I think some people might forget that markets can go sideways. Markets can go down, heaven forbid. So that's going to maybe catch some people off guard when that eventually happens. And you go back in history, year 2 of a bull market, like we just said, historically, what happens year 2? Well, the economy's doing great, right? Year 1 of a bull market, everyone's looking at each other like, how in the world are stocks going up? The economy's weak. Year 2 tends to be, wow, the economy's really good. Stock market might be a little choppy or flattish as it consolidates some of those gains. So it's not like, end of the world worries. I mean, year 2 historically, John's up 10 out of 10 times since World War II. Year 2 of a bull market usually is higher, but you can have some chop and some consolidation. The last time we had a year 2 of a bull market was in 2010. It rewind for a second. We saw a 16% correction in the summer of 2010. Stocks eventually went all the way back up to new highs by later in 2010, as we remember. But I think it's just key to remember history says year 2 can be choppy and frustrating. And honestly, I know the stock market's like making new highs almost as we speak, but you look at things like small caps, mid caps, if you've been in those all year, they've literally gone sideways all year. So there is some choppiness out there under the surface.
So, Ryan, second on the list of things that worry you right now is fewer stocks making new highs. So why should investors be concerned about that?
Yeah, Janet, you think about it, I kind of explain it like this. Think like an army, right? If the soldiers are advancing, the generals will also advance. But we don't have as many soldiers advancing. Like I said, just the other day, S&P is making new all-time highs, but we did not have very many stocks making all-time highs. Yeah, some of the large-cap tech names that kind of have been pulling things have been pulling the overall market higher. But when you don't have broad participation, again, it's not end-of-the-world stuff, but it is a warning sign, let's call it a yellow flag. It's a yellow flag that maybe something's a little off here, and the idea that, hey, listen, we're entering the seasonally weak third quarter. August, September historically been weak. After a big rally, some weakness under the surface, maybe some continued consolidation, or maybe even a 5 to 8% correction, which after a 90% rally would be perfectly normal. That's something that clearly has our attention.
Ryan, we always believe that that the market will return to fundamentals. We talk about that when we talk to you an awful lot. The last item on the list of things that worry you is elevated stock valuations. Now, let's draw a distinction if there needs to be one, because that does sound a lot like, hey, the market's at an all-time high, so it's not a good time to invest. And we just talked about 7 consecutive all-time highs recently before that dip at the first part of this week. Is that the same thing? And if not, what's the clarification there?
Yeah, I mean, let's clarify it this way. At the start of the year, valuations were high, and you would have missed 15% gains on the S&P 500 so far. So, we're not ignoring it. I mean, again, it's a concern, but that's a PE multiple, right? Price to earnings multiple. The price part is how stocks are doing. But that E part is actually up like 15% so far this year as well. So earnings in our eyes are almost justifying where stocks are. But just bigger picture here, that when you have those high multiples, you can kind of get knocked off. We've seen what happens when you have higher multiples and the market kind of gets a correction. Some of the higher growth areas with higher multiples like tech and growth, those areas might get hit a little bit harder. We saw that back in April when we had some of those concerns. So it's not as much a near-term concern, maybe like a 3 to 5 years out. Yes, returns after the huge rally we've seen maybe come back to trend here. But again, earnings season is right around the corner. I'm sure next time I'm with you guys, we'll talk about earnings season. There's a lot of expectations. Earnings season will continue to be strong, and that E part of the PE multiple can justify where we are. But again, it's that yellow cautionary flag again, I guess I want to point out.
Ryan, we all obviously use highly diversified portfolios here at Gen Wealth with the help of LPL Research and the models that you guys put together. And included in those highly diversified portfolios, in almost all cases, there is a fixed income component. And your research team recently talked about the fact that one of the biggest mistakes that investors can make is not adequately understanding the risk that they may be taking in their fixed income part of their portfolio. Talk a little bit about why that's a concern of yours and how investors need to be looking at that. Obviously, we think that fixed income has a role to play, but we also need to understand the risk.
John, that's exactly right. So Mark Zabicki, our new director of research, brought up this concept, and and talked about it a couple different places. And it's as simple as, we know stocks and bonds. People assume all bonds usually are kind of provide that safety net that when you get rocky times in stocks, they do well. That's like, your treasuries and some of your longer-term bonds. But we call those core bond holdings, right, that, again, tend to be that diversification and safety net, if you will, when stocks hit rougher times. There's the non-core area, and we call those things like high yield, right, emerging market debt, bank loans, but some mortgage-backed securities. What you need to know, if you've got a heavier investment in those, they tend to be a little more stock-like. Last March, mortgage-backed securities and bank loans really were crushed. March 2020, I should say, sorry, when stocks were going down, whereas your core bond held up a lot better. So we think it's so important for people to realize kind of what they're investing in. They hear bonds and they do certain things, but you don't always have that safety that you tend to get from core bonds. So that's not to say that you can't have a place, and believe me, there's always a place for bank loans and mortgage-backed securities and high yield. It's just to be aware that if the trouble really hits, what hits the fan, those areas might not provide the diversification needed. Here's a quick story, guys. I started with LPL in January 2015. January 2016. I'm adding a year there. I've had so much fun. January 2016. If you remember back to that time, the market really took it on the chin. And I was brand new, so don't blame me for this. We had some in our bond markets, our bond investments, we had a good deal of high yield exposure. What we learned then, and we're trying to remind people now, that did not provide the safety that we thought when we had bond exposure, because high yield was hit just as hard as stocks were hit in early 2016. And again, we saw that in March 2020. So it's just, in a low-yielding world, you want to reach for yield. That's where you get it from your bank loans and high yield. But still, just be aware it might not provide that safety net you thought you had when I should say, it's going to happen eventually, when stocks hit some turbulence.
Ryan, we've got just a couple of minutes here, but this is a topic that we hear a lot about. We talk about clients come in talking about the debt that the United States has on a regular basis, and they have concerns about that. What would you say with the state of the U.S. debt and a debate coming in August about whether to raise the debt ceiling again? What are your thoughts?
Yeah, well, to be honest, we do think the debt ceiling is going to be raised again, no matter who the president is, no matter what the party in power is. It seems like you kind of have that kick-the-can mentality. We don't think that's going to change. And in debt, clearly, we added so much debt, obviously, last year with the $5 trillion of fiscal stimulus and everything the Fed did as well. So that is the number one question, along with inflation, right? Debt and inflation, the two top questions we receive. But looking just at that, the government has a ton of debt. But if you look at corporate America, just companies, right? Companies' balance sheets are actually in the best shape they've been in a long, long time. Nothing like they were right before the financial crisis, where companies were leveraging a lot of debt. And also net wealth, right? I mean, debt's like an all-time high, but net wealth is at an all-time high, actually been increasing. So we think it's really important to point out the fact that debt might be high, but other aspects actually are almost justifying it. And again, could that lead to lower growth over the next 5 to 10 years, all the debt we have? Potentially it very well could. We saw that last decade of the 2010s when the stock market gains 400%, yet, you barely hit 2% GDP in your best year, and there's a lot of reasons for it. But the overriding debt could be a big reason. But at the same time, it's one of those things that we've heard about a lot of debt in the United States for a long time now, Janet. Mm-hmm. And, it hasn't really, I hate to say it doesn't matter yet, but there's other things that again, corporate balance sheets and earnings that really drive the economy more so. And those are things we're focusing on that are still more positives than that negative debt that we have.
Interesting perspective on that question. And as always, through the whole interview, Ryan, again, we appreciate you so much joining us while you're traveling. LPL Chief Market Strategist Ryan Detrick, thanks for being with us.
Guys, I'm honored. I did turn the air conditioning off. I'm sitting in this car. It's like 100 degrees. I'm going to turn the air conditioning on. It will make a bunch of noise. Next time I'll be in the office. So take care, guys. I appreciate it. Thanks,
Ryan.
Yes. Get Ready for the Future show continues right after this.
At Gen Wealth, one of our standards is that we're life changers. We believe one of the best ways to change your life is to educate yourself. George Washington Carver said that education is the key that unlocks the golden door of freedom. Let that soak in for just a moment. Think about the changes that you can make by learning more, specifically learning more about your money. We are passionate about education. We believe that it has the potential to change not only one life, but generations to come.
There's always been power in standing up for what you believe in, challenging the status quo, and never accepting the ordinary? What about the rest of your life? Will you settle? Or will your retirement be more? More fun, more family than finances, more than just investments? Connect with us at Gen Wealth and harness the power of more.
Want more straight talk about retirement, investments, and your money? Listen to our podcast on iTunes, Stitcher, or wherever you listen to podcasts. Now back to the Get Ready for the Future show.
Always like to offer a follow-up thank you to Ryan Detrick. He's probably not listening at this moment, but he's always gracious to join us, and we so enjoy the time that he gives us once a month, his insight and perspective from LPL research on the markets. And if you would like to sit down with a Gen Wealth advisor, want to give you an opportunity to know how to do that, you can reach out in one of two ways. You can call us toll-free at 866-653-PLAN. That's 866-653-7526. Or you can always send us an email, info@getreadyforthefuture.com. It's a conversation. That's what we're having today. If you have questions, you can send that in the comment section if you're watching on live stream today. We have a few questions we've gotten over the last couple of weeks when we've been asking for those questions on social media. And our next question on our list is, what do you think about the housing market right now? So getting kind of into the weeds on this a little bit. Boy, I mean, the general headline here, it's a great time to sell a house, but then you have to buy one, right?
Yeah,
I mean,
you got to live somewhere.
So there's a problem here, right? I mean, interest rates at historic lows. They have ticked up a little bit, I guess, in recent weeks, but they're still borrowing money is easy to do right now, but that has resulted in quite a premium, John, on purchasing a house.
Well, this is a classic inflation setup. If you take a look at the American public, they have more cash available these days than they've had in a long time. Mm-hmm. People have been very conservative, paying down debt and building up cash reserves. Well, as my parents used to tell me, that's money's burning a hole in your pocket, and you got to do something with it. And so what is happening in the housing market is really interesting because there are pockets across this nation of areas that the housing market is just nuts. I know all across the South, the housing market is really, really hot because a lot of people are moving out of areas that maybe, were really restrictive during COVID and things of that nature. And they're moving to the South where there's more sanity in terms of the government.
More freedom in terms of COVID restrictions.
Things like that. And so that's part of what's driving this, the availability of cash and then the availability of cheap money. Where I get concerned about this is when I hear that people are putting houses on the market at already an inflated price.
Yeah.
And then there are 7 or 8 offers, and those offers get bidded up. And so all of a sudden, people are actually closing on a house that may be 15 or 20% higher than it really ought to be. And they're going, look, I don't care what the appraisal is, I'm going to buy this house. Yep. That is the essence of a frothy market in real estate. And I know the real estate professionals that I visit with are concerned about when they take away the punch bowl, when interest rates go up, when the economy slows down, or whatever the case may be, who's going to be left holding the bag in this particular situation? And it's going to be those people that overpaid on houses. Mm-hmm. And here's what's happening, guys. They're running out and doing this, and they're saying, okay, if everything works right in my economy, then this will be just fine.
Right.
But how many times has everything worked just right in your own personal economy for an extended period of time?
And you don't control all those other variables. I mean, I think about in our neighborhood. Our neighborhood is very kid friendly, but it's also grandparent friendly. So there's a lot of people who want to live in our neighborhood. And so when a house, even before the housing market that we're in right now, when a house would come up for sale, man, it would go very quickly in our neighborhood. And now They're not even listing them with realtors. It's just going so quickly. But I look at like what you're talking about, John. If we have somebody who buys a house in our neighborhood and it's over the current value, and then in 5 or 6 years they want to move, because that's what a lot of people do. Now, we've all been in our houses since we built them many years ago, and we don't have any plans to move. But a lot of people are not like that. They'll live in a home for a period of time and then they'll move. And so if you're going to pay 15% more than the current value in an inflated value time period and then want to move, you better be thinking that through, because you're going to be stuck. You're going to be in a situation where you owe, at the time that you want out, you owe more on the house than its then current value.
Yeah.
I can clearly remember, and Scott, you were living here at that time too, back in 2008. This was a pretty desolate place around Saline County, because they'd built in 2004 through 2007.
Yep.
And, it was like, oh, the housing market's always going to go up, until it doesn't. And then there are a lot of people that lost houses, that couldn't sell their house when they needed to or wanted to, or had to take it, sell it, take it on the chin, as far as, they got more into it than what they had to come up with money to get out of the house. And so, you just, and I know that time, kind of dulls our senses to things like that, but you have to think about, how's this all going to go if something goes wrong? I think that's the question that anybody needs to ask if they're talking about buying a house.
And just think about the numbers and how easily that could happen. You're talking about premiums on housing about 20%. Most people are doing good to put 20% down on a house.
Yep.
So you could get upside down really quickly and have negative equity in that. So it is worth proceeding with caution, to say the least.
Let me talk to people who are just starting out, because I'm at that point in life where my friends have kids who are like, I'm out of college, should I buy a house? And you're a financial advisor, so they call me and go, hey, what do I need to be doing right now? If you are in a position where you're, let's say you're renting an apartment or something like that, but that rent payment is less than your house payment would be, unless you can find a steal of a deal on a house, which is highly unlikely in the current market, I would bank that extra money. And then when the housing market turns around, then you've got a significant down payment and you're not buying at a premium. And another opportunity, and this is highly dependent upon your family. For some families this would work, for some it would be a nightmare. But I know some people who are outside of college and they're living back at home with mom and dad, and they're sharing some expenses, because it's right to do that at this point. If you've got adult income, then you share some of the adult expenses, but they're able to bank a significant amount of money every month, and they're going to be able to turn around and pay cash for a house in the future if they want to.
Yeah, and I think that if you, again, go back to the 2008, 2009 time period, the folks that really made out really well during that period of time, or the folks that had cash that could buy those short sale houses and buy them on the cheap, and now they are able to sell those houses at a premium and capture some gains. And it really goes back to the old adage that Warren Buffett has always said, when everybody's buying, you need to be selling, and when everybody's selling, you need to be buying.
That's right.
One other thing that's driving this that we didn't talk about is what happened with the pandemic and everybody working from home.
Yes.
And I think that has shown companies that they don't have to bring people into the office. I think we're seeing a lot of people move because they can live anywhere now. Because they can do their job from home. And that will die down. So to your point, Janet, the win is very important here. So we want to address that. And that really ties, I think, into the overall perspective we have on inflation, and we continue to say that it is transitory. In other words, that we are seeing spikes in certain sectors of the economy in prices, but we believe that's going to levelize as things normalize in the economy. And I think that we've even talked to realtors that hopefully expect that by the fall, things are going to start coming back a little bit towards normal in the housing market. We're seeing that with lumber, John. New construction is another thing we didn't talk about. I mean, that was ridiculous to think about building a house a few months ago, but now lumber, which spiked about 400%, it has dropped in the last 6 weeks by 40 or 50. It's starting to come down, and we continue to read LPL research, which leads us to believe that inflation is indeed transitory.
Inflation is transitory, but if you're talking in the context of your retirement, it is going to be impactful on your retirement. Even a 2 or 3% inflation rate is going to be impactful on your retirement. Janet, I know you've done some research on this and have some numbers that you want to share in regard to inflation and how it really impacts retirement.
Well, when you think about 2%, it doesn't sound like that big of a deal, but we've talked about inflation being the silent thief. You know, it's like you've got money in your pocket and inflation comes up behind you and takes dollars out of your wallet because you have to have more money to be able to purchase the same goods, and it's just this gradual, almost invisible process. So it is very real, but what we see, and John, you were talking about the numbers, what we see is there are so many people, and I think particularly in the South, we live in a very conservative area. There are a lot of people who are like, I don't understand investing, so I'm kind of scared of it, so I'm going to have all this excess money in the bank. Well, guess what? That money that you have at the bank, above and beyond your savings amount, that money is earning jack diddly squat. That's the official calculation on it these days. It is earning jack diddly squat.
That on the calculator.
Yeah, there you go. It's there.
Diddley.
So here's the deal. You are going backwards in your purchasing power with those dollars. We actually ran a scenario recently for some clients who were getting ready to retire, and they had really all of their retirement assets sitting in cash-like instruments, so money markets, that type of thing. And what happened when we ran the scenario is they had, out of 1,000 different scenarios, they had 0 probability for success in retirement with their assets all sitting in cash. And guys, the answer to why was that is inflation. Because right now, on paper, it looks great, but we know inflation is real, and as the years progress through this couple's retirement, they're going to have to utilize more dollars each year to buy the same amount of goods. Therefore, we have to outpace in retirement. Here's your key. You've got to outpace your withdrawal rate and inflation over the years. And if you're not able to do that, and you can't when you're earning jack diddly squat at the bank, if you're not able to outpace inflation and your withdrawal rate, you're going backwards in what you have.
Yeah, when we say inflation is transitory, I think what we're saying is the current inflation rate is transitory. It will come back down, but inflation will still be with us, as we pointed out here.
Well, I mean, you talked about, Scott, going back to, we had deflation for a period of time last year because of COVID, and that makes the current inflation rates look worse than what they actually are.
Right.
And guys, I think that if you're looking at retirement and you're trying to decide, okay, how do I deal with this inflation thing? We've got a great opportunity coming up to actually plug into a workshop that we're doing that actually speaks to this inflation issue.
Yeah, and we're so excited to be actually doing workshops again, live and in person. COVID shut that down, and we were on the webinar, and those were great as well. But we are actually getting back out to live workshops, and there is one coming up this month called Destination Retirement. It's going to happen in Bryant. Well, it's actually in Benton. It's the Bryant area. Benton Event Center. July 29th is the date at 6:30. So make plans to attend Destination Retirement. And as John mentioned, we're going to go over 7 key steps to help you work towards your destination retirement. And a key component of that is how to have a retirement income plan that accounts for and plans for inflationary adjusted raises. You can visit getreadyforthefuture.com/events to register for free for Destination Retirement, July 29th at 6:30 at the Benton Events Center. Ask us anything. That's the subject of today's Get Ready for the Future show. We'll have a few more questions after the break.
The beauty of a potter's work is that each item is unique. No piece is the same. That's what makes it art. At Gen Wealth, we believe your financial plan should be unique to you. Through our process, your money is carefully shaped around your goals and dreams. Your future, artfully crafted. Call us today or visit our website and connect with us. Gen Wealth Financial Advisors.
Welcome back to the Get Ready for the Future show. Ask us anything. That's what we're talking about on today's show. Our next question on the list is, will Social Security be around for my retirement? And this one is an ongoing question that we get from clients, and it really doesn't matter to much extent how old they are. I do think it probably comes maybe a little more often from the younger client. But here's what we know. In a nutshell, yes, we think it will be around. We're pretty confident it will be around. What form, how much, that's what potentially could change. Well, here's what we know. If nothing changes, if there's no legislative changes, the Social Security Trust Fund for Retirement Benefits is projected to be exhausted by the year 2034. Now, if that happens, that just means there will have to be an adjustment to the amount of benefits that go out. By law, Social Security has to exist. They can't shut down the program without a legislative change, right? So there will be an issuing of benefits. So Social Security will be around post-2034, even if the United States government does nothing. What would happen is, if the fund is depleted, the Social Security Administration would have to reduce benefits possibly somewhere between 20 and 25%. And that would be across the board. So you could have a pay cut for current retirees. That's the danger. However, as we get closer to 2034, and I do think it's going to be December of 2033 when this happens, Congress is going to finally do something about it, guys. But they're going to kick the can. And you know, we give Congress a lot of grief on this, but the reality is the changes they're going to have to propose are not going to be popular depending on which side of the aisle you land on, and probably across the board.
Right.
And the biggest voting bloc in this country are people who are closing in on receiving Social Security checks, so they have to be very careful how they tread, but something has to be done.
I like to say us old people like to vote.
Yes.
And so there are, there's a huge amount of political pressure to do something about this. Now, if you want to be fatalistic about this and go, I just don't want to know, I don't think it's going to be there, then here's what you do. You reduce the Social Security benefit amount that you get on your statement, just reduce it by 25% in your planning process. And if you do that, then that's kind of the worst case scenario, because even if the trust fund runs dry, there's still money coming in from people working, and that money will have to turn around and go back out. There just won't be enough there to pay full benefits. So by their calculations, it's about a 20 to 25% reduction. And so, Janet, for folks that are just absolutely, doomsday feeling about this, then a 20 or 25% reduction in their anticipated Social Security check would be the right way to plan for that.
Absolutely. I will say, though, we haven't done the next issue of the Doomsday Edition on this yet. I don't think a lot of people have thought about the impact of COVID on this. Yeah. And frankly, the government has not done new calculations from that. And when you think about how many people were not working for an extended period of time and therefore were not paying into the system, and then many people who have not gone back to work even since that time, or people who worked at a lesser capacity and therefore they made less, so they paid less into the system, there will be an impact from that, whether it moves the timeline up or it changes the percentages. But there's something there to consider. But I'll go back to the Winston Churchill quote that I almost always talk about on Social Security. He said, on another topic obviously, but he said the American people, after exhausting all other measures, ultimately will do the right thing.
Right.
And I think with Washington, now it's questionable about what the details of the right thing are, but I think they will solve this in some way, and like you said, Scott, at very much the last minute, because ultimately they want to be reelected.
Did you see what just happened there, Janet, when she brought up that whole COVID impact on Social Security? I heard Xanax bottles opening all across Genwealth land.
There's a little dose of reality there.
And I do think the other component that is worth talking about is one of those solves, one of those fixes that could be out there is a means test. And so for higher net worth individuals or couples, Social Security could be in jeopardy in some way, shape, or form if that's the route that Congress goes to help fix it.
But it would have a lesser impact on those folks in that case. You can debate the fairness of that and all that type of thing. But I think what's more likely to happen is there's probably going to be an adjustment in the taxation on Social Security, where they remove the cap on Social Security taxes. I think there's also the possibility that folks like our kids will actually get a Social Security check maybe by 65, maybe by 70 or something like that. But I can see that pushing of that age downward toward, an older age for you to be able to qualify for Social Security. And that's actually legitimate because there are folks that are living longer and working longer. And so therefore they could, theoretically push that deadline, if you will, for being able to draw Social Security out a few years, and it would make the system a lot more financially stable.
I think for those of you who are still young enough to do some planning, before you get to retirement to bridge this gap. Now, if you're at the point of retirement, you've got planning to do regardless, but to bridge this gap, if you have time, I just think it speaks to the message that our country has really been sending for quite some time, and that is that your retirement needs to be your responsibility. That's something we saw in the shift from pensions to 401ks, and I would say the same thing here on Social Security. It needs to be the icing on the cake for you, not the cake itself.
Yeah, and I think that's why we exist really at GenWealth, is there was this big move away from pensions and things of that nature to do-it-yourself retirement. And we knew that people were not equipped to do it themselves. They don't have the education, the training, the knowledge, the ability to do the calculations and things of that nature. And that's what actually caused GenWealth to be able to exist, because in the land of pensions, you don't need a GenWealth.
That's right.
But GenWealth is I'll get it out in a minute. GenWealth exists to be able to help you plan for your retirement. And that's the whole ready to retire process that we put people through here at GenWealth to get them prepared for that ultimate retirement and the replacement of that paycheck.
If you'd like to go through that process, you can call toll-free 866-653-PLAN. That's 866-653-7526, or email us info@getreadyforthefuture.com. We've got time for one more question. Should I be concerned about rising taxes? You mentioned the taxes on Social Security. How about taxes overall? And I think there's two approaches to this. Under the current proposal, what President Biden is talking about, more than likely not. But over time, over the next 20 or 30 years, we are still, believe it or not, it's hard to believe this when you live in it, historically we're at pretty low income tax levels.
Yeah, and I think that there is a great deal of hype about, taxes and things of that nature. There are folks that are in our industry that really try to make a living on this whole tax issue.
Yeah.
But the fact of the matter is you got to pay tax on qualified money at some particular point in time. The question is, when do you pay it? And when you think about qualified money, that is the bulk of what America is going to retire on. It's 401k money, IRA money, things of that nature. Yes, you do have to pay income tax, federal and state income tax, on the withdrawal of those dollars regardless. It's the question of whether you're going to pay it now in the form of maybe like a Roth conversion, or you're going to pay it when you withdraw it. And there is no easy answer to that question. There's a lot of variables to that, and it's really something that I think that you should not really be making retirement decisions solely on the issue of taxation, because you just don't know exactly where that's going to fall.
I mean, I'll give you an example. We're working with a couple that they're going to be living on some excess savings. So cash money, non-qualified, we don't have to worry about taxes. They're going to do that for the early years in retirement. Well, that's a prime opportunity to do some Roth conversion. So that'll put them in a better situation later on tax-wise. But at the same time, we're going to be looking at how much of that are we going to convert, because if we convert too much, then it can put them in a situation where they're paying more on their Medicare premiums. And so I would say this really points to don't go it alone. There are a lot of little loopholes that if you don't know about it, frankly, they're landmines. They're not loopholes.
I think it's important this is how I would describe it. It's not about getting the tax out of the way. It's about strategically planning for it so you can minimize it. You're going to have to pay it, but minimizing it can be the proper strategy to go forward. We can't predict what politicians will put in place with regard to taxes, but we can create a plan to help you minimize the impact as you draw income in retirement. Has that ever happened? Like at my last word at the sentence?
Man, you must have paid Casey to time that.
Wow. No, I was watching the clock. I'm just that good of a timer.
Yeah. Oh, okay.
Today.
That is today. Yes. That's the bell for final thoughts. Janet, we'll start with you.
We've covered a lot of questions today, and I would say while there's a lot of different topics we've talked about, we might not have covered your question. Your question might be very individualized to your situation. So whatever it is that you're dealing with, whatever your stage of life is, whether it's about taxes or Social Security or a topic that we didn't even touch on, that's why we're here. We're very educationally focused. Feel free to reach out and ask us your questions, and we'd be honored to be able to help you in that way.
Scott, I will say that there is a huge difference between information and knowledge and wisdom. And there's a ton of information out there. If it were just an information question, then you can go to the internet and look it up and you get an answer. But it's really the context of that and how that information is applied to your situation and the proper application of that information that really does define wisdom and knowledge. And so what you get when you sit down with a Gen Wealth advisor is you get a whole team of people, all the way from LPL research to the team here and all the specialties that we have available here at Gen Wealth. You get a big team working to apply wisdom and knowledge to the information that you have. And I think that it's time to really step into the game and get the ready to retire process up and running and working for you as you head toward retirement.
My final thought is one of the great places to ask questions is by attending one of our live workshops, and they are back. Destination Retirement is coming to the Benton Event Center July 29th at 6:30. You'll learn 7 key steps to help you work toward your destination retirement. And you can visit getreadyforthefuture.com/events to register. It is free to attend. Put it on your calendar, July 29th at 6:30. We're out of time for this week. Hope you'll join us again next time.
The Gen Wealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Gen Wealth Financial Advisors is an Arkansas-registered investment advisor with securities offered through LPL Financial, member FINRA SIPC.